The QYLD ETF has a massive dividend yield of around 12%, pays out dividends every single month, and has even recently soared in price, making the fund up around 8% year to date. And this is all while most of the market has been in a slump. But the question is, does this ETF truly offer the massive income and financial freedom that some of the high yield chasers claim it does? Well, stay tuned, because in this video, we are going to do a deep dive into one of the most popular high yielding ETFs and see if it's truly worth investing into, or if this high yielding ETF is nothing more than a massive yield trap. We're going to go over all this and more right after you please drop a like on this video and subscribe for more content like this in the future. So QYLD, or the Global X Funds 100 Covered Call ETF, is an exchange-traded fund launched and managed by Global X Management Company. The fund invests in public equity markets of global region, and the fund invests directly in through derivatives into stocks of companies operating across a diversified sector. It uses derivatives such as options to create its portfolio, and it invests in growth and value stocks of large cap companies. In simple terms, the QYLD ETF is an investment fund that aims to generate income by utilizing a covered call strategy on the NASDAQ 100 index. And here's a little bit more on how it works. So QYLD focuses on the NASDAQ 100 index, which includes 100 largest non-financial companies listed on the NASDAQ stock exchange. These companies are well-known technology and more growth-oriented stocks. Now it then implements a covered call strategy, which involves selling call options on the NASDAQ 100 index, or individual stocks within the index. A call option gives the buyer the right to purchase shares at a predetermined price, known as a strike price, within a specific time frame known as expiration date. Now, because of this strategy, the fund is able to generate income. By selling call options, the ETF collects premium from the buyers of these options. These premiums paid serve as income for the ETF and its investors. The premiums received can be distributed to investors in the form of regular dividends. So now that we know a little bit more about how QYLD works, let's look into some of its fundamentals. So QYLD was created in 2013 and is currently down 31.66% as far as price goes on the all-time max chart. Now QYLD also has a sort of pricey expense ratio at 0.6%, but that amount is sort of industry standard for a managed fund like this. Now getting into the good stuff, QYLD does offer a massive dividend, which is most likely why the majority of investors are interested in QYLD in the first place. The main reason why investors are drawn to it is likely because of the idea of higher income generation from the start. When investing into lower yielding assets, even assets that have the potential to grow their dividend over the long term, something like SCHD, it's going to take the investor quite a bit of years in order to see a large amount of income start to be generated. Speaking for myself, for instance, I purchased QYLD a few years back because I was super interested in the idea of spending a small amount of money and receiving a massive dividend on a monthly basis. And speaking of a massive dividend yield, 11.75% is QYLD's trailing 12-month dividend. Now on the max dividend chart, you can tell one thing's pretty certain. QYLD definitely does not grow their dividend consistently. And unfortunately, there's even been months where QYLD's dividend was as low as 11 cents per share per month. But there's also been times where QYLD is offering 25 cents per share per month and pretty much everything else in between. One thing that definitely has had investors sort of concerned about QYLD in the last year or so is the fact that the monthly dividend has been dropping consistently. Back in 2022 and 2021, QYLD was offering north of 20 cents per share per month on a pretty consistent basis. But ever since halfway through 2022, QYLD's dividends have been anywhere from 16, 17, 18 cents per month, which income-focused investors can't really complain about, because 16, 17 cents per month is still around a 10, 11, or 12% yield. Now, maybe the most important thing to do, especially when it comes to some of these extremely high-yield ETFs or stocks, is to chart it out next to the S&P 500 and use the total return option as the metric. So total return is going to give you the total as far as share price plus dividends included. And what's shocking is that year to date, QYLD is up 14.4%, where the S&P is up 8.34%. So QYLD year to date has almost doubled the return of the S&P 500. Now on the 1 year time frame, QYLD is up 11.09% and S&P is up 6.23%. So on 2 time frames so far, QYLD has actually beat the S&P 500, but unfortunately not for long. On the 3-year time frame, QYLD is up 20.98%, which relatively speaking still isn't all that bad of a return. especially when investors are receiving a massive, juicy dividend payouts on a monthly basis. And it's important to keep in mind that some of these investors are using this monthly paid dividend to help them pay for their bills or retirement, or some of them are using the money to reinvest into more shares of more high-yielding ETFs like this. Now, on the 5-year time frame, things get a little bit more grim for QYLD. 5 years out, QYLD is up 25.2%, where the S&P is up 64.67%. And this paints the exact picture of a yield trap, and the exact thing that a lot of investors warn other investors about. Because you see, even though over the past 5 years, QYLD has paid a dividend every single month in the form of 17 cents, sometimes 20 cents or above, an investor still would have made almost 3 times the amount of money if they were to have invested into S&P 500 rather than QYLD. So what does this mean for this high-yielding covered call ETF, and where do we go from here? It's going to be interesting to see if QYLD can recover in price and get back above $20 per share throughout the next year if the market cooperates. But because of QYLD's strategy of buying a basket of stocks and writing covered calls in them, the overall appreciation of the fund is sort of doomed from the start. So the moral of the story is simple for all dividend investors out there, including myself. Even if a stock or ETF is offering a massive 10, 11, 12, 14, 15% dividend yield per year, it's very important to see how the fund has performed over time, what the total return looks like, and most importantly, what the actual strategy of the company or ETF actually is. But I want to hear from you guys down below. Do you think QYLD net is still worth investing into at these levels? And do you think QYLD is going to return back above $20 per share very soon here? If you enjoyed this video, make sure to please drop a like in the video and subscribe for more. Thanks as always, guys, and I'll see you in the next one.